All right, let's talk about one of the most controversial, most debated things in all of finance, the options contract. Now, I know it sounds super complicated, but I promise behind all that jargon, there's a really simple, powerful, and honestly fascinating idea.
And really, it all boils down to one big question, right? Is this thing a super sophisticated tool for a brilliant strategist? Or is it just a fancy way to gamble, a high stakes bet with a bit more math? That's what we're here to figure out.
Okay, so let's strip it all back. At its heart, an option is surprisingly simple. It gives you the right to do something, buy or sell an asset, but, and this is the absolute key, you don't have to do it. You have the choice. That's why it's called an option. And that choice, that's where all the power comes from. So, a right, not an obligation. I know that can sound a little abstract. So, to really get what that means, let's forget all the Wall Street talk for a minute and use a simple analogy. Okay, picture this. You've found it, your absolute dream house. And you've got this gut feeling, you just know its value is about to go through the roof. The only problem? You don't have the cash to buy it outright. Not yet, anyway. Well, this is exactly where an option could come into play. So, this house, that's our underlying asset, by the way, is worth a nice round $300,000. Buying that thing would take a serious amount of cash, right? A huge commitment. But what if, instead of buying the whole house, you just buy an option contract on the house? The price for that right, we call it the premium, is just 5 grand. That's it. $5,000 is the only money you've put on the line. And right there, that is the mind-blowing power of an option. Think about it. For just 5,000 bucks, you now control a $300,000 asset. That idea is called leverage, and it is absolutely central to this whole debate. Okay, so how does all this make the case for options being a strategic tool? Well, the people who argue for it say it's all about one thing: maximizing your potential upside while having a super clear, defined limit on your downside. So, yeah, the whole tool argument really comes down to these four things. We've already seen that incredible leverage, but it's when you combine that with defined, capped risk, the ability to protect your portfolio and even generate some income, well, that's when the argument gets really, really strong. So let's jump back to our dream house. Imagine your gut feeling was dead on. The value of the house skyrockets to $400,000. Well, your option lets you buy it at that old price, 300 grand. You get to pocket that entire $100,000 difference. I mean, think about that return on your initial $5,000. It's huge. But, okay, what if you were totally wrong? What if the housing market crashes and the value plummets? Well, here's the beauty of it. You just walk away. You let the option expire. The absolute most you can possibly lose is that 5 grand you paid for the premium. That's it. You've completely avoided a catastrophic loss on the house itself. Now, that all sounds pretty amazing, right? But it's only half the story. Now we have to look at the other side of the coin, the big counter argument, and it introduces the one thing that can turn a genius strategy into a complete bust: time. Yeah, you could almost call this the villain of our story: theta decay. See, every single options contract has a ticking clock, an expiration date, and every single day that goes by, the value of that option just melts away. It doesn't matter if the asset's price moves or not. The clock is your enemy. So think about this. Even if our dream house price stays at exactly $300,000, your option is losing value every single day. It's in this constant state of decay, just getting less and less valuable as that expiration date gets closer. Time is literally eating your investment alive. And this is the part that trips so many people up. With a stock, you can be right eventually. Time can be on your side. But with an option, no way. It's not enough to be right about the direction of the price. You have to be right about the timing, too. If that house price jumps the day after your option expires, tough luck. You lose everything. So with this relentless ticking clock, how on earth do serious strategists even use these things? Well, this is where the conversation gets really nuanced, because there are defensive strategies that completely flip the script on how you think about options. And this really highlights the core tension, doesn't it? When you own a stock, time can be your best friend. You can wait for it to grow. But with an option, time is your enemy, always. So what's the trade-off? Well, you're giving up that friendly relationship with time in exchange for something powerful, a risk that is completely defined and capped from the second you make the trade. This brings us to probably the strongest argument for options being a tool, using them as a form of insurance. We call this hedging. So you're not speculating anymore, you're not trying to hit a home run, you're just protecting what you already have. Let's say you own 100 shares of a stock, and you're worried the market's going to tank. You can buy something called a put option, and it basically sets a floor. It caps your potential losses no matter how bad things get. But there's always a catch, right? Just like your car insurance, it isn't free and it isn't forever. You have to keep paying that premium. You have to keep renewing the policy when the old one expires. And that constant cost, which is really just theta decay in disguise, can really start to add up and drag down your returns over time. All right, so we've looked at both sides of the argument. You've got the incredible potential of leverage and protection on one side and the crushing, relentless pressure of that ticking clock on the other. So let's try to bring this all home.
This table really lays out the two-faced nature of options perfectly. Look at leverage. Is it smart capital efficiency, or is it just a high-stakes bet? What about risk? Is it defined and capped, or is it actually a high probability of losing everything? And time. Is it just a known variable you plan for, or is it a relentless opponent that's always out to get you? It really depends on your perspective.
And I think that brings us to the real verdict here. The option contract itself, it's neutral. It's like a hammer. Is a hammer a tool for building a house or a weapon? Well, it depends entirely on who's holding it and what they intend to do. It's the same here. It all comes down to the user's intent, their knowledge, and their strategy. But this quote just nails that tension perfectly. It says that to succeed with options, you need the intelligence of a strategist, but the nerve and the predictive timing of a calculated gambler. It's like you have to be two different people at once, part cold-hearted analyst, part gut instinct gambler. So, we've laid out the whole case. You've heard both sides. The final question really is for you. Based on all this, what's your verdict? Is it a tool, a gamble, or is it something in between? What do you think?